All right, so let's talk about NFOs, and today I have with me Feroze Azeez, Deputy CEO, Anand Rathi Wealth. Feroze, quite a hot topic, discussing NFOs, and especially the kind of NFOs that we are seeing flooding in the market, be it sectoral, thematic. We are seeing ETF, we are seeing passives in different categories, a sea of NFOs right now, and also because we are in a bull run. This is a typical feature of a bull run also, where we see investor interest going in the market, and also AMCs making the most out of it by launching timely, trendy NFOs. But having said that, I'm sure one has to really plan participating or putting money in an NFO really well. It doesn't have to be as per the trend. Trend is your friend in investment, but not always, and especially not when you're trying to do a financial portfolio planning or strategizing it. So let's just first discuss the criteria of putting money in an NFO. But also, since the longest time, I know you've not been pro NFO, in the couple of interactions that we've had on the similar topic, Feroze. But looking at the timing, and in fact, I don't know if it's the apt time to invest in an NFO, what would be your rationale to consider one?
Yes, Kavita, like you said, NFOs have been in flavor extensively over the last couple of years, especially this year as well. So I have been negative on NFOs for the last 11, 12 years. Anand Rathi Wealth has not even recommended one NFO out of the several. And let me put some color in terms of how many NFOs have come so that people understand, can it practically be possible to buy NFOs itself? See, in this year, so far, we finished not the full 12 months, but we finished 9 months. We've had 145 NFOs already there, 190 last year, 222 the previous year, so on and so forth. If you look at the number of NFOs over the last 4 years, the average has been 175 number of NFOs every single year. Now, the amount collected is also so far 86,000 crores in this calendar year, and we've still not finished the 12 months. But since the AUM of the mutual fund industry is 66 lakh crores, we have collected 1.29% of the AUM through NFOs. I'm just putting some color and drawing a canvas of what this topic is, how big this topic is. So it's a very big topic. Now, coming to your pointed question, Kavita, I've been negative as a company and in turn as an individual, negative on NFOs, because I always believe that if you have to analyze something, there has to be history to it. So there has to be a compelling reason, very, very compelling reason for me to buy a fund which starts today, right? It's not a home I'm buying that I want a fresh home, not lived into, right? It's not a car I'm buying a mutual fund. So the more the data to analyze. So we've said NFOs, you can stay away. But having said which, things are changing. So the reason I'm giving you a longish kind of an answer. But today what is happening is, since people have already launched their diversified equity funds already, so if you see this 145, 71 are passive funds. 32 are thematic funds. So there are some thematic funds which are being launched at the right time by smart AMCs. So it might make sense. The timing of a thematic fund can be very easily made better by following the largest AMCs in terms of the trend. So trend is your friend is a very catchy line, or largely when you're buying an NFO using a platform for thematic schemes.
Having said that, I also, because I know you have a data, I mean, tracking back from, right from 2018 till now, the kind of NFOs that were launched, and now the performance, right now the performance of those kind of NFOs or those funds. So if in case, so just in, if I want to decode that, or if I want to dive deeper into that performance of these NFOs, obviously market performance has been one of the biggest drivers for these funds that were launched like back from 2018 till now. Overall, on an average level, how has the performance been?
See, if you look at the average level, and that's a very important barometer to see whether this NFO, did I miss something? Quite a few of Anand Rathi Wealth clients keep saying, "आप तो NFO बेचते नहीं हैं, किसी को देते नहीं हैं." So there is a FOMO, fear of missing out. So we look at this data very microscopically. If you look at the average performance of all multi-cap schemes, it is 43.37, the existing ones. The NFOs in the same category, so it's an apple-to-apple comparison, did 40.44. So if there is an existing fund group which did 3% more than the NFO, what was my reason to buy a NFO? in a conventional category like multi-cap. So if you look at flexi cap, which is also a great category in itself, if you look at the existing funds delivered 37.96 for the last 1 year, and the NFOs in the same category delivered 35.64. So what you can currently conclude with this small piece of information, not boring you with a lot of more information, never buy a diversified funds NFO. Is one thing you can definitely conclude because there are enough options already. But thematic schemes like HDFC Defense, for example, HDFC launched the defense fund absolutely at the opportune time. So HDFC is the second largest AMC, though the performance is 89%, 79%, right? And so what I'm trying to tell you is HDFC launched it at the right time and stopped accepting money at the right time as well. So I like the fact that large AMCs are timing their themes so much better than in the past.
Talking about the current type of NFOs, what kind of a diversification angle one can give, if at all they want to include one? Because we've seen sectors and thematic specific NFOs really flooding the market now. Huge big in flavor, themes like manufacturing, themes like defense, etc. Can we really look at this kind of diversification? I know that these themes and these sector-specific stocks, can be in your portfolio, whether through direct stocks or by having large cap or any other category fund. You will definitely have the exposure towards these categories, these sectors. But how do we decide if really one wants to invest in an NFO, a sector-specific NFO? What should be taken under consideration so that there is no overlap or repetition or overexposure in these sectors?
Kavita, this is the most apt question you could ask me on a topic like this, because NFOs have to serve a purpose for me, not for the manufacturer. See, the asset management company's job is to fill their bouquet with different products, right? SEBI has put a restriction on a number of products in conventional categories. So thematics have become quite popular because that's an open canvas, so people can launch more and more schemes. So it has to serve a purpose in my portfolio, not in the manufacturer's bouquet. So coming to the point of which are the themes which you should buy are the ones which are underexposed. Now, let me give you an illustration, right? A few days back, NSE has launched an index which only focuses on a group of stocks which are capital market related. Now, that's a theme which can run 10, 15 years, in my opinion. Not just 2 years, 1 year, and 3 years, because India is moving its money from debt schemes, debt to equity. So if that paradigm shift were to happen, then the capital market businesses which have some correlation to capital markets like RNTs, AMCs, wealth managers, all these businesses, custodians, all these businesses will have a collateral benefit of the financialization and the capital market investment. So that's which is an underexposed sector for the conventional scheme. So look at sectors which, like tourism, is another sector which, in my opinion, India has missed out on the huge tourism boom which it can capitalize on over the next 10, 15 years. There is an NFO or there is a theme which is invests in IPOs. So do something which is not me too, is the point I'm making, and I've given you some illustrations to articulate what I'm trying to say.
Feroze, how can one look at ETF? Because they are in vogue again. Investors, just because it's in trend these days, they want to make it a part of their portfolio as well. Having said that, what are the criteria of including an ETF in your portfolio? Should one be really looking at it?
Yes, so ETFs are good provided they are thematic ETFs. See, today, when you look at the ETF industry in India, 87% of the total AUM is in Nifty and Sensex. If you're going to be allocating money like the way currently India is allocated, I would say no to ETF. Mana ki US is very pro ETF, but that's a different country, different stage of capital markets. If you're buying an ETF, which is a thematic ETF, that's got some merit, because in a normal diversified fund, now if you're looking at tourism, like I said, there will be only 3 stocks or 4 stocks in a portfolio of tourism. But if you buy an ETF which focuses on tourism, all stocks are tourism. So suddenly you have 20 stocks of a theme you like. So buy ETFs, but not the conventional ETFs mirroring a Nifty and a Sensex. but trying to mirror something which is a theme which you are underexposed to. That's one very, very important criteria. Otherwise, I'm a complete no-no to ETF, because the model portfolio which we have ran for the last 11 years, audited, has delivered 4.27% more than Nifty. So why would I let go of such a return after cost also, if I'm able to beat Nifty and Sensex? Why have 88% like India has 88% or 87% in these two indices, which you can always beat using active management?
Feroze, I can see your NFO recommendations coming in different categories. Multi-cap category, two multi-cap, that's Canara Robeco multi-cap, Kotak multi-cap, and a quant value fund. There are existing funds in the same category, which obviously have a performance track record. Why not those funds, and why this NFO that you're recommending?
See, some people have this huge affinity towards NFOs. So these are recommendations for those who have already decided that they want to buy an NFO. So you're trying to buy something which those asset management companies are doing well. So the Kotak Multicap is an existing scheme. It's not an NFO. Quant Value Fund focuses on value as a sector. So point I'm trying to make is, I would not go in for NFOs unless somebody puts a gun on my head in the diversified category, especially the conventional.
All right. I just want you to highlight to our viewers DSP Nifty Bank ETF. In terms of performance and in terms of criteria, why one should be avoiding it?
See, if you look at past performance, it's a clear avoid. But I think if you look at banking as a sector, that has underperformed significantly, especially private sector banks are quoting at valuations lower than their mean valuations, except one bank, which is a large bank. The rest of them are quoting at discounts from their mean valuation. So what am I trying to get to? The minus 14.6% or 14.6% return as against 79 of the best sector. Of course, it's significantly lower, 65% lower than the rest of the other one which we see on the screen. That's because banking sector has not done very well. The good part about sectors is they are very cyclical in nature. Worse off the past performance, better is the future performance. So I would not be too averse to buying it today. And I would be very averse to buying a defense fund today, because defense has stopped running and it has done its justice already. And the rear view mirror is more prettier than the windsheet of the car.
One last question now, since the number of passive NFOs is almost around 71, in the entire new launches scheme. But then talking about passive as a strategy, I know we've had this conversation and discussion a lot of time, but what we are also seeing, because we get to interact with our viewers through our shows, they send us their queries, etc. So one common understanding right now that investors have is having a portfolio of passive is enough. To get the maximum out of the market condition or momentum these days. What is wrong in this kind of a strategy? And it is easier to fall in this kind of a mindset or investment momentum looking at the current launches. And also the kind of information we have on social media, and everyone around is buying passives and index and ETFs, etc. What is the biggest disadvantage of having just passives in your portfolio, be it of any category, any sector?
Yes, Kavita, see, if I can break the passives into two parts, one is a specific sector, which is underexposed in diversified funds. Let me treat that separate. They're passive, but not the conventional indices. See, the biggest disadvantage of buying ETFs or passives or index funds is that they operate on the growth principle in India. What do I mean by that? And this is a little technical, but the biggest fallacy, which we have to be very careful about. Because when you look at Nifty, let's assume, Nifty gives more weightage to those stocks which have done very well in the past. So what happens is, indices, the way they are created, are growth generally, which I mean, if the stock does better, there is more weightage to it. If there is more weightage, there is more money going into it. That results in it further doing well. So it's a vicious cycle of performance means more weightage means more money means more performance. So whenever the market changes from growth principle to value principle, most of the active fund managers start delivering significant alphas. And if you look at 2023, where value did better than growth, you will see our model portfolio outperformed Nifty by 16%. Okay, and I expect only 3% outperformance in a year where value took over. A growth fund or an index fund really couldn't deliver, especially on the large cap category. So be mindful that indices are created largely on the basis of growth. That's why in the US you see valuations of certain businesses are obscene, especially technology large businesses. Because little do anybody know, in Bank Nifty, for example, the top three stocks are 65%. Right? कहने को there are so many stocks, but weightages are given on the basis of past performance. So I was speaking to somebody who trades Bank Nifty for a living practically. I asked him, what are the top two stocks? Weightage, 50%. So you're better off. The risk is significantly more because most of the weight is pulled up. Nifty top 10 stocks is 65%. You may see 50 stocks optically, but 50 stocks, the last stock is hardly any weight. So be mindful of how indices are created before you take an index fund strategy, which is a cut copy paste from US.
All right, Feroze, that's all the time we have on the show today for this topic and discussion. Thank you so much for taking time out for this today.